So let's finish up cost-benefit analysis. A few more notes to talk about some special issues with cost-benefit analysis. Make sure we've been talking about net present value. Make sure we also do a quick talk through discounted payback and internal rate of return. And then a special issue of mortgages and cost-benefit analysis. Why did I tell you on your projects to do everything as if you bought it for cash and you didn't borrow any money? So remember we said a cost-benefit analysis, when you use net present value, it's considering your opportunity cost. What else could you do with the money? Because your discount rate is a hurdle. It's telling you, hey, if you can't make at least this much, this project shouldn't be done. And that hurdle is somewhat of an approximation on what you could do elsewhere. And incorporates risk. The higher the discount rate, the riskier the project, and so the more it's penalized. And then the timing of the cash flows. We saw that when we built our cost-benefit analysis, that we were real specific on what year the cash happens. So a few other issues that we have a net present value. So here we're talking about net present value in particular. Remember the net present value rule. If the net present value is positive, we accept a project. If it's a negative, we reject the project. Now that seems really simple. If you have two projects and you're trying to choose between them, then yeah, pick the one with the higher net present value. But there's a really important term right here, all else equal. But all else is almost never equal. And we'll talk about the profitability index. And let me give you a few examples. What if one project lasts 2 years and the other is 6 years? If the one that lasts 2 years, let's say it has a net present value of 10, and the project that lasts 6 years has a net present value of 30 or 25, which should you do? Well, if you do the project that lasts 2 years, you get a net present value of 10, and after 2 years, you can do another project that might have a net present value of 10. But if you do the project that lasts 6 years, it lasts 6 years. You're stuck with that project for 6 years. You can't do another project until year 7. Would you be better doing the project for 2 years, getting a net present value of 10, where there's a chance at year 3 you could do another project that has a value of 10? So that makes it a little tough. And then the size of the projects. Let's say both projects last 6 years. The first project has a net present value of 10, and the second project has a net present value of 10. But what if this one costs 400 and this one costs, let's say it's only worth 11, net present value 11, but it costs 1.1500. So the net present value is 10, but you only have to pay 400 to get that net present value. The other one, net present value of 11, but you have to expend 1.5, 1500. Well, in that case, I might rather do this project. Its net present value is lower, but I could do almost 4 of these projects for one of these. If I can find another project that costs 400, 500, 600, but has a net present value just of 3 or 4, I would be better off doing a project with a net present value of 10 that costs 4, and another one has a net present value of 3 that costs 6. Those two together cost 1,000, but they give a higher net present value than this one project that costs 1,500. So that's why that all else equal is so critical. I'll say profitability index will help you some, but it doesn't fix all of these. It fixes the project size problem, so we'll certainly get into that. But when you have mutually exclusive projects, you don't really say just take the one with the higher net present value, but that will not always give you the best answer. Now, a lot of times it won't be mutually exclusive projects, where mutually exclusive means if you do A, you can't do B. So you got to pick between A and B. Usually what happens is you have 10 projects and you could do all 10 of them, but you don't have enough money to do all of 10 of them. So you would like to say, if every project is a positive net present value, we should do it, because that will increase the value of the firm. But if that costs $4 billion and we only have $1 billion, remember on your project one, we had the capital expenditures, the CapEx, as a percentage of cash from operations. The firm, if they can borrow money and add more money to do these capital projects, that would be great. But at some point, they're just going to run out of money. They just cannot do every single thing that's possible. So they're not mutually exclusive. They can do every single project if they had enough money, but they don't have unlimited resources. So they have to somehow prioritize a project. So how do they do that? And one technique some people do is the profitability index. The profitability index is essentially the present value of all the benefits divided by the initial project cost. I don't want you to use the profitability index in your projects because it really only makes sense if you have 9, 10, 15 projects to look at. You only have one project, so the profitability index really will not tell you anything. Obviously, if all your present value benefits divided by your cost, if that's greater than 1, then obviously you have a positive net present value. But what the profitability index helps you with is projects that have different sizes. And it tries to get you the most bang for the buck. So how much is your present value versus how much you have to spend to get it? Now, will it give you the best answer? Not always, but it probably will, on average, give you a better answer than other techniques. Ideally, what you want to do is look at every single combination of projects, and the one where you have all the different combinations, the one combination that gives you the highest net present value. So let's say you have 15 projects, but you only have enough money to do 7, 8, or 9 of them. Then you look at every single possible combination of those 15 projects so that you spend your entire capital budget, and the one combination that has the highest net present value, that's what you want to do. So the profitability index, if it's greater than 1, the net present value is greater than 1. So what you do is you rank all your projects by profitability index, and you pick the ones that have the highest until you run out of money. But again, that may not give you the best answer because the 6th project that you bring in may eat up all of your capital. But then you look and say, well, if I did 7 and 8 instead of 6, I could actually do more projects, because with project 6, I can only do that one project and I have 500 left over. But if I do 6 and 7, I can do 6 and 7. I don't have any money left over, but I get a higher net present value. So again, the profitability index may not give you the best overall answer, but it will probably give you a better answer. Now, there's a big problem with this entire analysis. Every time I read a textbook on net present value and capital rationing, I always laugh out loud, because they're written as if all of these projects show up all on the same day. And the firm needs to decide, wow, which projects are going to do. Well, here they are. Here's the 15 projects. Let's figure out which ones we can do. But that is not how it works in practice. In practice, 3 projects show up in January, 7 show up in February, another 2 show up in March, then you get 20 show up in April, and it's this ongoing deluge of projects. It just is not possible to have this nice, clean process. And I struggle with this a lot at UTSA. How do we get our hands around this process? And it's practically impossible. You do the best you can with what you can work with. You don't want to tell people, hey, only give us projects in July. That's when we'll decide. If you have a great idea in October, then you should be able to do that project in October. Remember the cash handling project you did for your financial applications? Hopefully you've already done that project by now. That was a great project, and the faster we did it, the better off we were. If we found that project in October and they said, well, you have to bring all your projects in July, we would have wasted several months wasting money on a really cumbersome process with our customers upset. So it's real messy. Just trust me, it's much more messy than the textbooks lead you to believe. I have to wonder if the people who write these textbooks have ever worked for a firm where they had to do these kind of things. It's just, the textbooks seem really artificial to me. So that's what I say here. It really works so cleanly as the textbooks say, because it's somewhat of just a haphazard mess that almost has to be that way. So projects with unequal lives, there's really no possible way to compare them, because they're really very different projects. There are techniques out there that try to fix this, but they're complex and they're unlikely to be used in a firm just because they're so complex. It's going to be a tough time to get your accountants and your project manager to understand them. So most people say, net present value, if you use that, you'll be fine. That's always the best answer. I'm not convinced of that. We'll talk about that when we talk about internal rate of return. I do think net present value is superior to the other approaches, like discounted payback and internal rate of return, but I don't think it's as perfect as the textbooks say it is. It does have its flaws. All right. The next model, remember this one, discounted payback. Remember that was the one that was so difficult to set up. It took quite a bit of formulas, the if function and all that to get it to work. So that was a frustrating one. And it's not a real technically economically valid one. It has a lot of problems, but you calculate the payback and then you make sure the payback is below the cutoff period. Remember we did that with our projects that we did for the financial applications. So where did you get that cutoff period from? Well, that's some subjective artificial number. Now for your projects, I want you to calculate the discounted payback, but I don't need you to come up with a cutoff period. I think the discounted payback is actually really, really quite powerful. It tells you when in the project's life did the net present value go exactly to zero. When did it go from being a bad project to being a good project? If that's 6 months, that's wonderful. If it's 20 years, that may be a little too long. And the reason I think CEOs especially like discounted payback is because they don't trust forecasts out more than 2 or 3 years. If it takes you 8 to 9 years to get this project to work, technology is changing so fast, there's a good chance by the time the project makes sense, something new has come along and it no longer makes sense. So I think it's essentially what the firm is saying is when we're trying to break a tie, in these mutually exclusive projects and are in capital rationing, we have to break a tie. We have two projects that are very similar. I said use the profitability index to break ties. Some firms say, you know what, let's use the discounted payback to break ties. Let's have a preference for projects that pay back faster than projects that pay back longer. So, and this is why I use it at UTSA. Let's use the payback, but let's use it in conjunction with net present value. Let's help us prioritize projects there. And it does come back to we prefer quick wins, and also we don't really trust forecasts out. In this environment, as fast as everything is changing, we don't trust forecasts out that many years. Now the downside with payback is once you hit your payback, it ignores all the cash flows after their payback period. So if you have this massive payback cash flow in year 4, but your payback is 3 years, and you're trying to compare, you got two projects, they both have a payback in 3 years, but one has this huge payout in year 4, the payback doesn't know that. It says, hey, the payback's 3 years. That's why I say if you use it in conjunction with net present value, you see they both have a payback about 3 years, but one has a much higher net present value because of that year 4 payback. Then the combination of the two will probably give you the right answer. So what I said is use a project has a positive net present value and the payback's less than 4 years unless it's a very strategic, important project that has a huge benefit after the payback period. So those exception projects where payback really misses the value on those projects, you can have an exception to ignore payback and still do the project. They're very strategic. Some of you have projects that you're going to do for this class. For a good example is solar panels. A solar panel will not pay for itself in 3 or 4 years. It will probably take 15, 16, 17, 18 years. Real estate projects where you're trying to decide, do I rent an apartment or buy a house? You're not going to get a payback there of 4 to 5 years. It's probably going to be 25, 30 years. So there's some projects, or if you do, some of you might do a franchise. If you do a Subway franchise, you are not going to get a net present value that's going to pay back in 2 or 3 years. It's going to be a long-term project, and you just have to accept that. I still think the payback period is important. If you're trying to decide between an electric vehicle and a gas vehicle, and the electronic vehicle has a positive net present value over the gas vehicle, but your payback period is 8 years, you say, you know what, I'm not sure this car will last 8 years. And it's tricky because electric vehicles will last longer than gas vehicles most likely, so it can be tricky. We'll talk about that. We're going to get into that in your projects and how we handle some of these special issues, because they can be really quite messy. Okay, another flaw in payback is it ignores the timing of cash flows. If the cutoff period is short, this may not be material, but so that's why we use discounted cash flows in our calculation. So that fixes it. A lot of firms, they don't use discounted cash flows. They just use the actual cash flows to do the paybacks. You can see for our purposes, doing the discounted payback, it made the Excel model much more difficult to set up. You had to do a lot of extra work. But it's more theoretically correct. And once you get it set up, you notice that with your Excel applications, once you get it set up, it's really not that difficult. Each project, then you've got the formula set up. It's just a matter of putting a new project in. So for your projects, for your teams, I absolutely want a discounted payback, not just a regular payback. Then we get the internal rate of return. So the internal rate of return, the rule there, if your internal rate of return is greater than your cost of capital, just like we built in the Excel applications, if that's the case, then you accept. So if your cost of capital is 6%, that means we need to make at least 6% to do this project, but your internal rate of return is 7%. You're making 7% when your requirement is 6%. That's an acceptable project. You do that. Now, most of the time, not all the time, but most of the time, if your internal rate of return is greater than your cost of capital, your net present value will be positive. Because essentially what the internal rate of return is what rate do you need such that it makes your net present value exactly zero. When you put that equal X IRR into Excel, that's what Bill Gates is doing. He's finding a rate such that your X NPV is exactly zero. So there's no formula for net present value. You just, in Excel, you just enter the X NPV formula. So the rules are usually consistent. Some people say, well, if net present value is positive and IRR is greater than the cost of capital, maybe a good rule would be, rather than ranking projects based on net present value, maybe we should rank them on IRR, because IRR has a similar property to that profitability index, where the IRR takes into consideration the size of the project. So you might say, forget about the profitability index, let's just use the internal rate of return. I would be fine for that for ranking. You have to be careful though. There are a few problems with internal rate of return. One is if you have a cash flow in the future that is negative. So let's say, normally we say at time zero there's a negative cash flow because we make an investment. And then we have all these positive cash flows in the future. There are some projects that at the very end of the project they have another negative cash flow because they have to shut everything down. When you do that, internal rate of return can actually give you two answers. And that can be really frustrating. A lot of textbooks say if that's the case, go with net present value. I'm going to talk about that I do not agree with that. I think textbooks are wrong on that. So that's one issue. You can get two IRRs if the sign changes on your cash flow more than once. Normally it's negative followed by positives, but if you have any negative cash flows in the future, you can get multiple IRRs. You will not get multiple NPVs, but I do not think NPV is more reliable than IRR in those cases. So in that case, most textbooks say, oh, because of this, IRR is worse. I disagree with that. I think NPV and IRR, and I'll talk about it, both have the same problem. The big problem with IRR, I believe, is the reinvestment assumption. When you do a project, you will get these positive cash flows. And so you have to think, what am I going to do with these positive cash flows? the IRR assumes when you get positive cash flows, you reinvest them at the internal rate of return. So if your cost of capital is 6%, but your internal rate of return was 14%, the IRR approach assumes any cash flows you get, you reinvest at 14%. Well, that seems a little excessive. Maybe this project's great and it has a high return, but why would you assume any cash flows you get, you can find another great project and invest at 14%? The net present value assumption is any cash flows you get in your project, you'll reinvest at the cost of capital for the firm. So if your cost of capital is 6%, net present value assumes that you can reinvest at 6%. That is a superior assumption. So that, in my mind, is the main reason why net present value is probably the better model, or is the better model in internal rate of return, if you had to pick between the two. But as I just said, you can use them both and let them kind of work off of each other. Now this reinvestment assumption is somewhat interesting to me. I remember I got a project, and I'll show you an example of this. So I get this project, and what they want to assume is we're going to make some investment income here, because we have $15 million coming in. And so what they assumed is we'll have some investment income. Now we won't get any the first year because this $15 million comes exactly at the end of the year, but the next year we're going to make 8% on that. And in the very last year, we'll make 8% on the 15 million. We'll make 8% on the 20 million. And we'll make 8% on the 8% we made last year. So there's our investment income. So what does my investment portfolio look like? Well, at the end of the first year, I'll have $15 million. At the end of the next year, I'll have $15 million plus $20 million plus $1.2 million. At the end of the next year, I'll have $36 million plus another $25 million plus an additional $2,896,000. So they said, wow, look at this. Here's my portfolio. Look at all these cash flows that we have. So essentially they said their cash flow was you invested $50 million. The next year you made $15 million but no investment income. The next year you make $20 million plus $1.2 million. Next year you make 25 plus 2.9. They said, let's look at this net present value now, and our net present value now is $3,897,000. They said, look at this great net present value we have. Because there's my cash flows, right? I got $15 million the first year. The next year I got $20 million plus I made 8% on the $15 million. Next year I made $25 million plus I made 8% on the $20 million plus 8% on the $15 million plus 8% on the $1.2 million. There's my cash flows. Wow, this project is wonderful. $3.8 million net present value. And when they came to me, they told me this was a sales leaseback project. And I thought, wow, sales leasebacks don't have large net present value. All you're doing is you're selling your building to somebody and then you're going to rent it from them. And to think that kind of projects can have this massive net present value. So I knew something was wrong. But this ending number is real important, 64,096,000. Did they really get these cash flows? This is what they'd have at the bank at the end. And essentially what they're saying is, wow, we'll build up to there. That's that 60. Some of these cash flows is your ending balance in your portfolio. Is that really how they did? And what I told them, their biggest mistake, remember the 64,096. Their biggest mistake they made was they assumed they got this $15 million, and then they assumed they invested it to make 8% to get this $1.2 million, but they never had to wire that money to anyone. I mean, think about how crazy that would be. You have $100,000 and you want to invest it in a bank certificate of deposit. So you call up your bank and say, hey, I have $100,000. I want to invest it. You're paying 2%. I want that 2%. However, I don't want to send you the $100,000. I want to keep the $100,000, but I still want you to pay me the 2%. That's essentially what they said. What they're missing here is they received the $15 million on the project, but they never sent the $15 million to the company paying them 8%. So to get this correct, what they really did was they had $15 million come in, but they had $15 million go out. Then they had $20 million come in, and they had, well, before I do that, I want to put this number down. Remember this 816,177.15. All right, let me just actually even just paste it here. Remember that number. So they had 15 million come in, and then they invested it to make 8%, so it goes right back out. They had 20 million come in, and then they invested it to make 8%, it goes right back out. At the very end, what do they have? They have 64,096,123. What is that net present value? It's exactly the same thing. And I forced them to have to change their project to reflect the fact if you're going to put investment income in there, you've got to put those investment cash flows in there. That's the true cash flow. And you get the exact same answer. Why? Because what did I say about net present value? The reinvestment assumption for net present value is that you reinvest at the discount rate. So if you do that, you don't need to do all of this investment income stuff. You can ignore that. All you do is you just put in your cash flows. You don't have to put the income in. And there you have your net present value. So you see there's a reinvestment rate assumption embedded in net present value. It's in there. It's already incorporated. You don't need to do anything additional with that. So that's what I mean by the reinvestment assumption, and it's automatically in their net present value has a really good reinvestment rate assumption. I just demonstrated it to you there. Let's talk just a second about what happens if your project has a negative negative cash flow in the future. The internal rate of return gets really confused on that because you can get all different rates that give you a net present value of 0. And so textbooks would say use net present value because it's acceptable. But that's really not the case. So net present value, they say it works, but the problem is if you got a cash flow, a year 5 cash outflow, let's say it's a negative $500,000 in year 5, if you discount that at 1.08, let's say 8% to the 5th power, I mean, think about that when you think about discounting cash flows. Let's say there's some risk with this $500,000. You don't know if it's going to be an outflow of $500,000, it might be $600,000, it might be $700,000, so it's risky. So if you have a discount rate to reflect the risk, think about that though. The higher your discount rate, the lower the present value. And we use higher discount rates because of more risk. But if you think about here, a higher discount rate here, 9% versus 8% versus 7%. The problem here is the higher the discount rate, that is more risk, the less negative the net present value will be. So this is an issue for net present value as well. If you have a future negative cash flow and you're trying to incorporate risk by using higher and lower discount rates, with negative future cash flows, higher discount rates will actually make that cash flow less negative in today's dollars. So it goes the opposite. So what I recommend, a better approach for this, instead of just discounting at the discount rate, is to use a lower discount rate for future negative cash flows. We're not going to get into that. I used to cover this quite heavily in this class, but I don't anymore. I just want you to be aware of the issue. So if you ever have a project where there's a negative cash flow in the future, I recommend either using the firm's cost of debt or using a risk-free rate like the treasuries. We'll talk about lower discount rates that you can use. You do want to discount it, because if you have 5-year delay in spending $500,000, that's an advantage of having to spend the $500,000 today. If I can push that negative cash flow out 5 years, I should get a benefit of that delay and analyzing my project. However, my discount rate shouldn't be the high number, it should be a lower number. So just think about that. And anytime you have a project with a future negative cash flow, net present value will not handle that future negative cash flow correctly. So I would show you with numbers, but I can't get the net present value function to give me exactly what I want. So, all right, so there's an issue. There's one place where textbooks say net present value is better than IRR. I think they're both flawed, but I do think there's a way, at least with net present value, to fix it by simply using different discount rates for negative cash flows than you use for positive cash flows. All right, so how do you do forecasting? This is a very high-level forecasting. Benefits and costs should all be measured in cash flow terms, not in accounting terms. All right, so what does that mean? That means when you do your projects, you don't have to worry about depreciation because depreciation is non-cash. Now, I realize for a project with depreciation that there is a cash flow related to the tax. The IRS allows you to depreciate assets and get a tax deduction for depreciation. We're doing all of our projects pre-tax, so that's not an issue, but in real life, you do have to incorporate depreciation. Depreciation itself has no cash flow, but the tax benefit of depreciation has a cash flow, but we're ignoring that. So we're not looking at accounting terms. Just because the accounting says that to record something, we don't use that in cost benefit. We do cost of benefit entirely based on the timing of the cash flows. So if you have taxes and a tax impacts, and again, we're ignoring taxes for our projects, then the benefits should be shown exactly when the taxes are paid. My huge advantage where I worked was I could just go to the tax department, had a great friend who was the head of the tax department. I would just tell her what project I was working on, she would assign me someone, and essentially they would just come back and give me the numbers, and I would just plug their numbers into the project. And that's usually what you want to do, because you don't want everybody in the company to become tax experts. Let the tax department give you those numbers. And so I'm leaving that out. Now, if you do net present value in an accounting class, they may make you do all of this stuff with makers tables and all that. So this class will give you a good high-level understanding. If you're an accounting major, you may have a management accounting class where you have to actually go into that detail. My argument is the tax department will do that for you, so you really don't have to worry about that. Your accounting classes, if you're an accounting major, they'll probably go into that because some of you may go into accounting for taxation, the tax accountant, so they won't expose you to that. So management will want to see the financial impact possibly. So you buy a machine, but you're going to have depreciation. So management may want to see, well, if I do this project, you're telling me it has a net present value that's positive, so that's great, but what is my GAAP accounting going to look like next year when you do all that depreciation? So management may want to see it, that's fine. So what I would do is I would do the project on both a cash basis, where I did my net present value, and then I would just do a scenario of the accounting basis so they could see what the accounting impact would be. We actually had one project that we kicked out because of that. It was a very tax-driven project where the IRS gave us these huge tax advantages. There was no cash flow. The cash flow was zero. However, the accounting, we had to do this massive accounting write-off. So our accounting income was horrible. It had a terrible impact on the accounting, but the cash flow was fine. And we decided not to do it because we knew, first of all, the CEO would not like that accounting impact, but also because it was not an economic project at all. It was essentially taking advantage of the tax code, and we just didn't want to mess with it. But there are some projects that look very, very different on a cash flow basis versus an accounting basis. And you want to take that in consideration. You don't want to surprise management with a huge accounting write-off and then just tell them, well, don't worry about it because it's not cash related. Make sure they know that in advance. So, all right, so here's the issue of what about you want to do this project, but you're not going to pay for it with cash, you're going to borrow money. So what is the issue here? Why do we not do that? Why do I want you to assume whatever you do, assume you buy it with cash, that you don't use any debt at all? So here's an example. I'm hoping you can follow this. This is tough stuff. If you're a finance major, if you're an accounting major, you need to understand this. If you're not, some of you cybersecurity people are doing great in this class, and I hope, man, you may find you want to switch to finance. Learn this stuff, understand this finance. So let's look at this. So first of all, let's say we did this on your financial applications in Excel. Let's say you're going to borrow $500,000. So remember, you have your time, you have your beginning balance, you have your interest expense, you have your payment. Remember the present value interest factor of the annuity. You just take that $500,000 divided by that PVIFA, and that tells you how much your payment is. There's your mortgage ending balance. So you borrow $500,000 at the end of 5 years, it's paid off. So here we do a project, and let's say the project's $1 million. So here we set up the net present value, and there's our cash flows, our net cash flows. We're going to ignore the mortgage, our discount factor. We do all of that, and we get a net present value of $114,257. Our mortgage rate is 5%, and our cost of capital is 5%. Now let's do it with the mortgage. What happens with the mortgage? So let's look at this. The cash flows are the same. We didn't change the cash flows. They're exactly the same, but now we have a mortgage. We borrow $500,000. So our net cash flows are much different. Instead of $1 million outflow, we only have a $500,000 cash outflow. Why? Because we borrowed $500,000. But then our future cash flows are different. Why? Because we made the $245,000, but we got to pay back the mortgage. When you do the discounted payback on that at 5%, what do you notice? The net present values are exactly the same. No difference whatsoever. Now it's more complicated than that. And this next part, and I've shown people this, if your discount rate and your cost of capital, your mortgage rate and your discount rate are the same, you get the exact same answer whether you use the mortgage or don't use the mortgage. This is the same if you're buying a car. You buy the car with cash or you buy the car on borrowing money, you'll get the same net present value whether you include the debt or you don't include the debt. All right, so this next part is going to set us up for the next topic in our class, where we're going to talk about forecasting a little bit. But after forecasting, we're going to talk about cost of capital. So let me show you the more complicated approach. Our 5% mortgage is what we call cost of debt, because that's borrowing. But our investment is cost of equity. It's how much do we need as the investors. So the bank needs 5%, but we as investors in the company, we need 8%. All right, and you can kind of ignore these numbers, but on average, we're going to have about 46% of our money is going to be mortgage, and about 54% is going to be our money. Now, why isn't it 50-50? 500,000 of the mortgage, 500,000. Well, because we're paying off the debt over time. So on average, our debt's going to be about 46% and our equity about 54%. And we'll see, we're going to do weighted average cost of capital. That's one of our next topics. We just weight those two, and we get a cost of capital of 6.63%. Now when we do the net present value, we get $65,000 as our net present value. Why? Because our discount rate's higher. What if we include the mortgage? And this is where it gets really, really tricky. If we include the mortgage, these cash flows are no longer cash flows for debt and equity. This cash flow here includes both our debt and our equity, right? Some of this money is going to go to the mortgage, some of it's going to come to us, so this is debt and equity. We're doing a mortgage, but we're not reflecting it. So these cash flows are going to be split. But let's say we let's put the mortgage in there. Well, now these cash flows are all our cash flows. It's all equity. And so when we use the discounted cash flow there, 100%, with all of us being equity, we get the same net present value. So this is going to be really hard to grasp right now, but if, and this is my main point, if you use the correct discount rate, I'm a little bit out of space here, so I'm going to shrink this down a little bit. If you use the correct discount rate, 6.63% if you use both debt and equity, which is what this cash flow here is, If I show the cash flow and I ignore whether it's debt or equity, I just say, hey, this is both people's cash flow. This belongs both to the person loaning us money and to us as the owners. If I do that, then my discount rate is 663, and there's my net present value. If I include the mortgage cash flows, so that my net cash flows are only my cash flows, then my discount rate is 8%, and I get the same net present value. If you do your project with and without the mortgage, so here you're assuming the cash flows is both for the mortgage and for the owners, and you also try it so your cash flow are only for the equity holders, and you get different net present values, then your discount rate is wrong. So for example, let's say this person says, you know what, my cost of capital is 663, but I'm going to use a mortgage, and so they instead put that 663 in there with the mortgage. Their net present value looks at $86,000. That number is incorrect. That is an error, because they use the cost of capital for both debt and equity, but their cash flows are only for the owners. It excludes the cash flows for the debt. So these are only the owners' debt cash flow. They should be using 8%. All right. My guessing is a lot of you are like, wow, what is he talking about? I'm setting up this cost of capital. Good news for you, for your projects, is if you're planning on borrowing money, you can just ignore that and do your cash flows as if you bought the entire thing for cash. Because if you do it correctly, you will get the same net present value that you would have gotten if you set up the mortgage. All right. Now, I actually had a real estate person in a previous class, and they did it like this, and they used the 663, and they got a much higher net present value. And I explained the error that they made in doing that, and he had to go back and correct it. And real estate people, I don't think we have any real estate majors in here. This is a very common mistake that real estate people make. Even though they're finance majors, they make this mistake quite frequently. And so they tend to exaggerate the net present values. They like to put the debt in there. It's just the way real estate people are. They like to put the debt in there, because if you think about buying a house, what they like to say is, hey, your mortgage is only $800 a month, but if you rented an apartment, that's $1,000 a month. You're only paying $800 instead of $1,000, and they always focus on that debt. That's fine if you want to do that, but you got to make sure you use the correct discount rate for your cash flows. So if you want to set it up for mortgage, that's fine. You want to show people, hey, your mortgage is only $115,000, but if you rented this property, you have to pay $140,000. That's fine. You can set that up. You can talk about it. But when you do the net present value, make sure you're using the right discount rate. We'll get more into this, but again, the good news for you is this is how you should set up your project. Even if you're planning on borrowing money, you can ignore it and you do everything pretending like, assuming that you did everything on a cash basis. All right, I'm going to stop it there because that's quite a bit to sink in. Maybe we should just real quickly finish up the last few notes here. What kind of cash flows do you use? Only incremental cash flows. The cash flows that if you do the project minus cash flows if you don't do the project. You include avoided costs. So if you do this today, you won't have to do this in the future. That avoided cost is a benefit. So I'll give some examples of that. So bottom line, anything that is different if you do the project versus if you didn't do a project, that all should go into your analysis. I'll be talking to you a lot when I'm talking specific with your teams about how to set up these projects. Relevant costs do not include financing costs. That's what we just did. You don't have to put that mortgage in there. It's already captured in your discount rate. That's the whole purpose of the discount rate, is to show how much you're going to do with debt, how much you can do with equity. If your discount rate's correct, you've already covered it. It doesn't include investment income. I showed you that investment income. You got the same answer whether you included investment income or not, because that reinvestment rate assumption is already in there. Forget sunk costs. If you already spent money and you can't do anything about that, that's the sunk cost. So, you look at what are the cash flows going forward. And if you've already spent $15 million, you know, that was a mistake. If you knew that before you spent the $50 million and you went and done the project, that would have been good to know. But you've already spent the $50 million. You can't do anything about it. And your question now is, should I spend the additional $10 million? Well, if you spend the additional $10 million and you get a benefit of $15 million, then you should spend the additional $15 million, the additional $10 million, so that you can get the $15 million. If you say, well, I've already spent 50 and now I'm going to spend another 10, I'm only going to get 15 million. Well, if the only way you can get that $15 million is to spend the additional 10, you should spend the additional 10. Allocated costs, we already talked about that. Remember when we did the cash handling project? Those allocated costs, those costs that would not go away if you did this project, they'd just be allocated to someone else. Then those are costs you should ignore in the project, and we actually ignored those in our project. Remember what an FTE is, a full-time equivalent. So tax benefits, we already talked about that. Go to your tax department. I'm going to ignore taxes just because I'll leave that for your accounting classes. But as far as taxes go, you should use the marginal tax rate, not the effective tax rate. Marginal tax rate is what is the tax on the next dollar you earn, so that you make sure you're making a marginal decision. How far in the future should you go? We'll talk a lot about that in your project, but you want to go the economic life of the project. So if you're doing a car, maybe that's 6 or 7 years. If you're doing solar panels, maybe that's 25 years. If you're doing a house, maybe it's 50 years, or maybe you assume you sell the house after 10 years, so you cut it to 10 years. So I at USA, what I did is I created an exhaustive checklist of benefits and costs, so people could go through that checklist to make sure they didn't forget something. Like you might say, oh, training, I forgot about training. If I do this project, I'm going to have to spend $10,000 training people on this new software or something like that, just to give them a checklist. If you have terminal cash flows, those negative cash flows in the future, we talked about that. They can come from all different places. So we won't get into much of that unless your project has that. Purchase versus lease, I'm not going to get into that. You can read this sidebar. I did some purchase versus lease analysis. Those are really not net present value projects. Those are really cost of capital projects. Essentially what you're asking, is it better for us to borrow money the way we normally do, or should we borrow money through this lease operation? If you normally borrow at 4%, but this lease is set up to loan to you money at 3%, then do the lease. So that's not really a net present value. I'm going to skip this example, but just real quickly, this guy, I'm not going to read the article, but this guy said, what if I spend $15,000 to buy a wind turbine, and I can save $20 a month on my power bill? He'll get a tax credit of $3,000, so he'll essentially spend $12,000 to get $20 a month. He really made his this is a true story. He made his neighbors really mad because they really did not want a massive windmill in their neighborhood, and he had it in his backyard. And he said, even if it was a 50-year payback, at least I've done something to reduce our dependency on fossil fuels. Notice he says payback, not 50-year discounted payback. If you do the net present value of this project, you make $20 a month, you spend $12,000 to get it, you will find out that this project never goes positive net present value. It is always, even if you give inflation on this $20, that your savings goes up with inflation every year, this project never pays for itself. It may have a payback that's okay within 50 years, but that's because you're not discounting the cash flows. As soon as you discount these cash flows, and let's think about it, this is really straightforward. If you spend $12,000, and let's say your discount rate is 5%, think about that. 5% times $12,000, that's $600. So your cost of capital is $600 a year, and you're only making $240 a year in benefits. You're not making enough in benefits to cover your cost of capital. So this project's a bad project. I just wanted to show you a real-life example. All right, we'll start here next time. So I know there's some confusing things today, but important things. So I hope you finance majors, it really sunk in. Accounting majors, everybody else, do your best. Hang on. and we'll get into it when we talk specifically about projects.